Hello friends, today's topic is determination of annual value, which is defined under section 23 of the Income Tax Act. So in the previous section we have studied what is the income from house property, what is the house property which is taxable, and in whose hands the same will be taxable. In this section we will be studying how to determine the annual value, how to determine the gross annual value of the property, what are the conditions in it, and what are the various sections, which is self-occupied property, let-out property, deemed to be let-out property, and various other sections. In this section, we'll be studying how to determine the annual value of the house property. The same has been defined under section 23, and it says how to determine the gross annual value of the property and how the same will be taxable in the hands of the SSC. For example, first subsection is 23(1)(a). So clause A of subsection 1 of section 23 and clause B of section 1 and section 23. What does it say? On the screen you can see where the house property is let out throughout the year. In those cases, we'll read the bare act. First is subsection 1 for the purposes of section 22. For the purposes of section 22, 22 is the charging section. The annual value of any property shall be deemed to be, clause A, the sum for which the property might reasonably be expected to let from year to year, or where the property or any part of the property is let and the actual rent received or receivable by the owner in respect thereof is in excess. This word is important. Is in excess of the sum referred to in clause A. Clause A is nothing but rent which is reasonably expected from letting out of the property. Reasonably expected. So clause A says any rent which is reasonably expected. Clause B says when compared to the actual rent value, if the actual rent is in excess of the sum referred to in clause A, wherein the expected rent is less than the actual rent received, the amount so received or receivable will be the annual value. This is the clause B. Clause C on your screen, where the property or any part of the property is let and was vacant during the whole or any part of the previous year, and owing to such vacancy the actual rent received or receivable by the owner in respect thereof is less than the sum referred to in clause A, the amount so received or receivable. So in case of vacancy, the amount of rent received, if it is less as compared to the expected rent, which is as per clause A, then in those cases the actual rent received or receivable will be the annual value. So here there are two terms which are coming up. Clause A of subsection 1 of section 23, clause A says expected rent is the annual value. Clause B says expected rent should be compared with the actual rent. If actual rent is more, take it. So meaning if expected rent and actual rent, after comparison of expected rent and actual rent, whichever is higher, the same will be termed as annual value. And if due to vacancy the actual rent is lesser than the expected rent, the actual rent receivable is the annual value. Proviso on your screen. Provided that the taxes levied by any local authority in respect of the property shall be deducted irrespective of the previous year in which the liability to pay such taxes was incurred by the owner, according to the method of accounting regularly employed by him in determining the annual value of the property of that previous year, in which such taxes are actually paid. So, based on this proviso, based on the proviso of subsection 1 to section 23, municipal taxes paid by the SSC will be allowed as a deduction to the SSC, and the same will be deducted from the gross annual value, which is determined as per clause A, B, C. Explanation. Next is explanation, which says for the purpose of clause B or clause C above of this subsection, the amount of actual rent received or receivable by the owner shall not include. The actual rent received or receivable shall not include, subject to such rules as may be made in this behalf, the amount of rent which the owner cannot realize. The amount of rent which the owner is unable to realize won't be included in the actual rent received or receivable. So there are two adjustments for the actual rent received or receivable. One is vacancy, which is under the clause C. So this vacancy, for this vacancy, you can term it as that this is one of the adjustment for actual rent received or receivable. If there is a vacancy, it should be adjusted for the actual rent received or receivable, and accordingly, if it is, even if it is lesser than the expected rent, the actual rent received is the amount of annual value, and the second adjustment to the actual rent received is the amount which cannot be realized by the owner, provided it will be allowed as a deduction against the actual rent received, provided the condition mentioned under Rule 4 are satisfied. The conditions which are mentioned in Rule 4 we will be covering separately in the next slides. So, to sum it up, on the screen you can see gross annual value is higher of expected rent and actual rent or receivable, actual rent received or receivable during the year. Second point, expected rent is higher of fair rent, municipal value, but restricted to standard rent. So the gross annual value has two parts, expected rent, and second is actual rent and actual rent. However, expected rent is further divided into fair rent, it's further divided into fair rent, municipal value, and standard rent. So fair rent or municipal value, whichever is higher, and it is restricted to standard rent. Based on this, the expected rent will be derived, and thereafter it will be compared with the actual rent of received, whichever is higher in general terms. Whichever is higher, expected rent or actual rent, will be termed as gross annual value. Then this gross annual value will be deducted from the municipal taxes and net annual value will be derived. So, third point, what is municipal value, what is fair rent, and what is standard rent? Third point, meaning of municipal value. Municipal value is the value determined by the municipal authorities for levying municipal taxes on the house property. So, value as determined by the municipal authorities is the municipal value. Fair rent means rent which similar property in the same locality would fetch is the fair rent, and standard rent is fixed by the Rent Control Act. So, standard rent is as per the Act, municipal value is as per municipal authorities, fair rent is the rent which is prevailing in the locality of the SSC. In the particulars, you can see computation of GAV. Computation of GAV is nothing but computing ER expected rent. ER is nothing but higher of municipal value and fair rent, higher of municipal value and fair rent, but restricted to standard rent. Step 2, compute actual rent received receivable. Actual rent received would be adjusted for unrealized rent, which is as per Rule 4. Step 3 is compare the ER and actual rent received receivable, is whichever is higher is the GAV, which is the step 4. And gross annual value will be adjusted for municipal tax. Gross annual value is adjusted for municipal taxes. Net annual value is arrived, and thereafter there are deductions available under section 24 of 30% standard rate of NAV and interest, if any, borrowed on capital. So it will be allowed on accrual basis. It could be pre-construction interest or any interest paid on ongoing basis during the current year. Again, interest would be allowed on a pre-construction interest or any interest which is paid during the year, and accordingly the income from house property will be derived. One illustration to make your concepts more clear on how to derive a GAV based on the condition that the property is let out, which is as per subsection 1 and subsection 2 of section 23. So considering in this illustration the property is let out, on your screen Mr. XYZ owns 3 houses, all of which are let out. Compute the GAV of each house for the information given below. In the particulars you can see municipal value is 70,000 for house 1, 70,000 and 65,000. So we shall consider house 1 first. Let's consider house 1 first. In this you can see municipal value is 70,000, fair rent is 90,000. So municipal value or fair rent, whichever is higher. So for now 90,000 is the amount. There is no standard rent applicable, and actual rent received or receivable is 92,000. So fair rent or municipal value, we will get the expected rent. Expected rent is nothing but 90,000 in this case, and 92,000 is the actual rent which will be compared. So whichever is higher, 92,000 or 90,000, whichever is higher is the GAV. So in first case the 92,000 amount is the GAV. So in the house 1 you can see 92,000 will be GAV. House 2, in under house 2 municipal value is 70,000 and fair rent is 60,000, whichever is higher. So 70,000 is still now the expected rent. It will be restricted to 75,000. So 70,000 will be the expected rent here. It will be compared with actual rent received or receivable. Accordingly, whichever is higher will be considered as GAV. So 72,000 is the amount which is GAV. House 3, under house 3, municipal value and fair rent both are same over here. So anything we can take, and it will be restricted to standard rent. So 65,000 is expected rent. It will be compared with actual rent received or receivable. So in that case expected rent will be higher, and accordingly 65,000 we will have as the gross annual value. So the gross annual value, determination of the gross annual value, is coming from subsection 1 of section 23, which is as per clause A, B, C. In a nutshell, if you see, this summary will help you out in determining the gross annual value, which is coming from subsection 1 section 23. If you see the particulars again for revision purpose, compute expected rent. Expected rent is nothing but higher of municipal value and fair rent and restricted to the standard rent. Then the expected rent is compared with the actual rent received or receivable, should be adjusted for the unrealized rent, which is again which at all the rule 4 conditions are satisfied for the unrealized rent, then only it will be adjusted for the actual rent received or receivable. So higher of expected rent and actual rent received is the gross annual value, and then the same will be adjusted for municipal tax, and net annual value will be adjusted for deductions under section 24, which is interest deduction and 30% standard deduction. Thereafter the income from house property will be derived, and for this purpose, for the determination of GAV when the property is let out, we have solved an illustration as well. Now moving on to the next part, which is treatment of unrealized rent, which is explanation to section 23(1). In this case, we are stating the again start. In this case, we are stating the conditions based on which the unrealized rent will be allowed as a deduction under will be allowed as a deduction against actual rent received or receivable. So for this purpose, the conditions are rule for conditions you can see as highlighted portion. First is the tenancy should be bona fide. Tenancy should be bona fide. Fine. The defaulting tenant has vacated or steps have been taken to compel him to vacate the property. So the defaulting tenant is no more occupying the existing property. Also, the defaulting tenant is not in occupation of any other property. So any other property is also important. So not only the existing property but also any other property of the SSE is not being occupied by the tenant who is not paying the rent, from whom the owner from whom the SSE is not able to extract the rent amount. And the condition fourth is reasonable steps have been taken. Reasonable steps have been taken to institute legal proceedings for the recovery of unpaid rent or satisfy the AO or satisfies the AO assessing officer that legal proceedings would be useless. So proper legal proceedings have been instituted by the owner. That's what has to be stated to the assessing officer. So if these four conditions are satisfied as per rule 4 of income tax rules, then in those cases the same could be taken as a deduction as unrealized rent against the actual rent received. So first pointer, I will read it again. The actual rent received receivable should not include any amount of rent which is not capable of being realized. So again it says that it will be allowed as deduction if these conditions are satisfied. Illustration. Mr. X is a property whose municipal valuation is 1,13,000 per annum. The fair rent is 1,10,000 per annum, and standard rent fixed by the Rent Control Act is 1,20,000. So as per the first para, municipal value of fair rent whichever is higher, so 1,30,000, and it will be restricted to the standard rent which is 1,20,000. So till now we have derived the expected rent which is 1,20,000. Then the property was let out for a rent of 11,000 per month throughout the previous year. Okay. Unrealized rent was 11,000. Unrealized rent is 11,000 over here, and all the conditions of rule 4 are satisfied. So there's unrealized rent of 11,000 and the property was let out for 11,000 per month. So effectively only 11 months has been received by the SSC. So 1,21,000 per annum is the actual rent received, and the same will be compared with 1,20,000, which is the expected rent, whichever is higher. Actual rent is 1,21,000. Then unrealized rent, which is already deducted. After that we have derived, and the municipal taxes is nothing but 1,30,000 into 10%, which is municipal taxes, nothing but deduction of 13,000, then the net annual value is nothing but 1,21,000 minus 13,000, which is 1,08,000, and on this amount 30% deduction will be allowed, and 40,000 interest amount. Here is the amount. 40,000 interest amount will be allowed as deduction, and accordingly the income from house property will be derived. So continuing with the example, in which case 30% deduction will be allowed. So 30% standard deduction is nothing but 30% standard deduction is nothing but 1,08,000 into 30% is 32,400, which will be deducted, and less, is also less interest which is borrowed, which is again 40,000. The income from house property is nothing but 1,08,000 minus 32,400 minus 40,000. So 35,600. 35,600 is the income from house property over here. So in this we have studied that how to determine a GAV when the property is let out, which is mentioned in subsection 1 of section 23. Now moving on to the next part, which is when let out property is vacant for part of the year. So we have studied example in which the let out property, in which case unrealized rent is not realized. There is an unrealized rent which is as per section 25. So how that is deducted from the actual rent when certain conditions are satisfied as per rule 4 of income tax rule. Now, in which case where there is a vacancy, when the property is vacant, then what are the terms and conditions and how to determine the annual value. First part, where the let out property is vacant for part of the year or owing to vacancy the actual rent is lower, than the expected rent on account of the vacancy. In those cases, the actual rent received or receivable will be GAV. So, in normal terms, if it would have been in normal circumstances, expected rent and actual rent received or receivable are compared, and whichever is higher is the gross annual value. However, if the actual rent is lower because of the vacancy in a way, for example, out of 12 months, for 2 months the property was vacant for want of tenant. The owner was not able to obtain the tenant for 2 months, and for the remaining part of the year, for 10 months, he was able to let out the property. So in those cases, the actual rent received or receivable will be only for 10 months, and the expected rent could be on a higher term as compared to actual rent received or receivable. So in those cases, when the expected rent and the actual rent is compared, in those cases where there is a vacancy, the actual rent received or receivable will be the gross annual value because there was a vacancy, and even if the actual rent received or receivable is less as compared to expected rent, the actual rent will be the gross annual value. In the particulars on your screen, you can see computation of GAV compute ER. Compute ER is same, higher of MV and fair rent but restricted to standard rent. Step 2. In step 2, compute actual rent received or receivable. Actual rent received will be adjusted for unrealized rent if conditions are satisfied as per rule 4. Find step 3, compare expected rent and actual rent and compute the let out period. So here the comparison is expected rent and actual rent is compared. In normal conditions, in normal circumstances, whichever would have been higher will be considered as gross annual value. However, since there is a vacancy, the actual rent received or receivable will be gross annual value. In step 4, you can see if actual rent is lower, the actual rent is lower than ER owing to vacancy, the same is lower, then actual rent is the GAV. If actual rent is lower than ER due to other reasons, if there are other reasons over here, then ER is the gross annual value because it is higher than actual rent. In normal circumstances, as I have stated earlier, ER will be the GAV. However, in spite of vacancy, if the actual rent is higher than ER, then actual rent is GAV. Obviously, if the actual rent and ER, if comparison between the two, if actual rent is higher, then actual rent will be the GAV. Again, these are the normal steps which we have studied in subsection 1 of section 23, in which case municipal taxes are deducted, then standard deduction and interest on borrowed capital is deducted. So section 23 subsection 1 clause C, in those cases if there is a vacancy, how to determine the gross annual value has been stated in section 23 subsection 1 clause C. In this regard, an illustration: Mr. X has a property whose municipal valuation is 2,50,000, fair rent is 2 lakh. So higher of the two is 2,50,000 and it will be restricted to standard rent, which is 2,10,000. So in a way we are saying over here that 2,10,000 is the expected rent. So again is 2,10,000 and the property was let out for a rent of 20,000 per month. However, the tenant vacated the property on 31st of Jan 2020. So for 2 months the property was vacant. So effectively the rent will have to be computed. The actual rent which has been received is 20,000 into 10. 20,000 into 10, this is the actual rent received, and unrealized rent was 20,000 and all the conditions prescribed by rule 4 are satisfied. So actual rent, if 12 months I will mention over here, so 20,000 into 12, which is 2,40,000. If actual rent, if actual rent, this is 10 months, which is 2 lakh. And if you compare the expected rent, if you compare the expected rent with the actual rent over here, then the actual rent is lower than the expected rent, but it is on account of vacancy. It is on account of vacancy that it has dropped to 2 lakh. If there would have been no vacancy, if there would have been no vacancy, 2,40,000 minus the unrealized rent, obviously it would have been 20,000. So ideally it was 2,20,000 only, even after unrealized rent. So it is only on account of the vacancy that the actual rent is lower than expected rent, and accordingly the actual rent will be the gross annual value. Right? So gross annual value is nothing but actual rent received, which is mentioned over here, and this will be adjusted. Actual rent received is further to be adjusted with the unrealized rent, which is nothing but 20,000. So actual GAV is nothing but 1,80,000, then less municipal taxes if any. Municipal taxes is stated over here as 8% of the municipal value. So 2,50,000 into 8%. 2,50,000 into 8% is nothing but into 8%. It's nothing but 20,000. So actual value is 1,80,000 municipal taxes. I will short term it as empty. So it will be less 20,000. NAV comes to 1,60,000 and standard deduction is allowed. Standard deduction at 30%, which will be 1,60,000 into 30%. 48,000 will be deducted over here. Less any house property, yes. There is a loan as well. Interest is nothing but 65,000 deducted. So income from house property is nothing but here we have 1,60,000 minus 48,000 minus 65,000. So 47,000 is the income from house property which is taxable. So here the crux of the situation was how to determine the expected rent. How to determine the gross annual value was the crux of the situation, in which case on account of vacancy the actual rent was lower than the expected rent, and accordingly actual rent was GAV, through which the unrealized rent was adjusted, and accordingly the municipal taxes and standard deduction were considered. So accordingly, in this illustration, the income from house property for assessment year 2021 is 47,000. In examination, you will have to draw a table, draw proper computation along with notes, in which case there would be a proper format which I will be sharing it with you. But for simplicity purpose herein and to save time herein, I am solving it in the note section over here. However, student must be sure that they are preparing a proper format, adhering to a proper format, and mentioning notes which I am communicating. So that could be mentioned in the notes, and how they have derived the computation, they can mention them in the notes. So in the examination, you will have to, if this sort of question is asked, you have to prepare a proper computation in a format along with preparation of notes. So moving on to the next section. The next section is subsection 2, section 23, which is related to the self-occupied property. Self-occupied property, in those cases, this could be an example in which the property is occupied by the SSC or by his family for the residential purpose, and in those cases the gross annual value is always nil. There is no deduction of municipal taxes. Also, there is no deduction of municipal taxes. However, 30% deduction that won't be eligible as such because there is no gross annual value. So only deduction which is available under self-occupied property is the interest on borrowed capital, which is restricted to 2 lakhs, and only for two house property. If a person has multiple house property, for example, so only for two house property the property can be claimed as self-occupied or unoccupied, and accordingly the gross annual value GAV can be considered as zero. So if a property is self-occupied, it is a benefit in the hands of the employee, wherein there is no gross annual value is taxable in the hands of the SSC. However, if there is any loan pending against the house property and against the self-occupied property or the unoccupied property, then that will be allowed as a deduction that will be limited to 2 lakhs overall for the self-occupied or unoccupied. So we have discussed the meaning of the self-occupied property, in which it is occupied by the SSC or by his family members for their own residential accommodation. And the unoccupied property is something which the SSC is unable to occupy, or any of the family members are unable to occupy. For example, the SSC is unable to occupy the house property because out of employment he has to visit to another state, another city, and the property in which he was staying currently as a residential accommodation cannot be accommodated, cannot be occupied. Accordingly, that is unoccupied, and obviously he is not able to rent it out as well. Accordingly, that will be unoccupied property. So for such property also, the gross annual value will be nil, and there will be no deduction of municipal taxes paid by the SSC on such property. There will be no standard deduction of 30%. However, if at all there is any loan pending, then the interest amount on accrual basis will be allowed to the SSC, subject to overall limit of 2 lakhs. On the screen, self-occupied property on unoccupied property, which is mentioned in section 23 subsection 2. Was pointed where the property is self-occupied for own residence or unoccupied throughout the previous year, its annual value will be nil. So here the word throughout the previous year is important, in which case the property should be self-occupied or unoccupied throughout the previous year, then only its annual value will be nil, provided no other benefit is derived by the owner from such property. If he has any sort of income from the property, then that won't be termed as self-occupied or unoccupied, and it will be termed as let out property, and accordingly subject to tax as income from house property. Meaning of unoccupied property. Unoccupied property refers to a property which cannot be occupied by the owner by reason of his employment, business or profession at a different place, and he resides at such other place in a building not belonging to him. Third pointer, the benefit of nil annual value is available only for up to 2 self-occupied or unoccupied property. So as stated earlier, the annual value can be considered annual value of self-occupied property of only 2 self-occupied property or unoccupied property will be considered. The benefit of nil annual value in respect of 2 SOP is available only to individual or HUF. Fine. No deduction of municipal taxes is allowed in respect of such property. Fine. Now, what does the Bare Act says? Subsection 2 of section 23, where the property consists of a house or part of a house, which is in the occupation of the owner for the purpose of his own residence, that means the self-occupied property, or cannot actually be occupied by the owner, by the SSC, by reason of the fact that owing to the owing to his employment, business or profession carried on at any other place, he has to reside at that other place in a building not belonging to him. That is definition of unoccupied property. So clause A, self-occupied property. Clause B is unoccupied property. The annual value of such house or part of the house shall be taken as nil. Fine. Particulars. Annual value under section 23 subsection 2, deduction under section 24, deduction under section 24 for self-occupied property or unoccupied property. They will get a benefit of deduction of interest that will be limited to 2 lakhs, and also there is another condition wherein if the loan is considered. If the loan is taken prior to 1st of April 99, then the deduction will be limited to 30,000. It could be either for the purpose of acquisition of the property, or it could be either for the purpose of repair, renovation of the property. However, if loan is taken post 1st of April 1999, then the interest allowed on acquisition of the property is allowed till the ceiling limit of 2 lakhs. However, the interest on repair or renovation of the property continues to be 30,000 even if the loan is taken after 1st of April 1999. On your screen, point A, interest on loan taken for acquisition or construction of house on or after 1st April 1999, and the same was completed within 5 years, and the same was completed within 5 years from the end of the financial year in which capital was borrowed. Interest paid or payable in for one or two self-occupied properties subject to maximum of 2 lakhs, including apportion interest, which is including the apportion pre-construction interest, meaning the interest amount of 2 lakhs includes the pre-construction interest, the interest on loan taken for acquisition or construction, the interest on repair or renovation. It will be ceiling limit of 2 lakh will be applicable if the loan is taken on or after if the loan is taken on or after 1499 and the same was completed within 5 years from the end of the financial year the capital was borrowed, then the interest paid or payable will be allowed as a deduction. And point B, in case of loan for acquisition or construction taken prior to, so here we are prior to 1499 on repair or renovation at any point of time. Sorry, again, start. Point B, in case of loan for acquisition or construction taken prior to 1499, the interest amount will be restricted to 30,000, and if the loan taken for repair or renovation or reconstruction at any point of time, meaning to say repair and renovation, if it is taken prior to 1499 or if it is taken post 1499, the interest paid or payable cannot exceed 30,000 for repair, renovation or reconstruction. Accordingly, the income from house property will be derived, wherein the aggregate amount of interest on borrowed capital allowable under A and B cannot exceed 2 lakhs, and it includes even the pre-construction interest. Illustration: Mr. X has one house property at Bangalore. She stays with her family in the house. Okay, it is a self-occupied property. The rent of similar property in the neighborhood 25,000 per month. Fine. The rental income in this case won't matter because it is self-occupied and accordingly GAV will be GAV again. Accordingly GAV again start. Accordingly GAV will be nil. The municipal valuation, municipal taxes won't matter because it is a self-occupied property. The house the house construction began in April 13 with a loan of 20 lakhs. Fine. Taken from SBI Housing Finance Limited on 1/4/2013. The loan was taken on 1/4/2013. The construction was completed in on 30th of November 2015. So it is within 5 years and the loan was taken for construction. Okay, so the loan was taken for construction and it is post 4th of 1st of April 1999. So the deduction that could be allowed is 2 lakhs and not 30,000. The accumulated interest up to 2013 is 3,30,000. The accumulated interest up to 2015. So for 2 years, 2013, 13-14 financial year and 14-15 financial year. For 2 years, the accumulated interest is 3,60,000. I'll just mention this in the note section. You can say pre-construction interest. 3,30,000, which will be divided by 5, which will be allowed in assessment year 2021, meaning in 30th of November 2015, the construction was completed. So 15-16, 16-17, 17-18, 18-19, and 19-20. 19-20 will be the last financial year. Just to give you background, since we haven't covered the pre-construction interest yet. So in those cases, pre-construction interest is something which is the interest expenditure which is incurred prior to completion of the construction or acquisition. In this example, the pre-construction interest will be from 1st of April 2013 to 31st of March 2015 for 2 years. The pre-construction interest, in a way, if the construction in our example has been completed in 15-16, that is 30th of November 2015, so in financial year 15-16, the construction was completed. Accordingly, the amount of pre-construction interest will be up to the financial year which is immediately preceding the year of completion. So the year of completion in our case was is 15-16, and the pre-construction interest started from 1st of April 2013, and it will end on immediately preceding year, which is in our example is 30th of March 2015. So for 2 years, and they have given in this example they have given 3,60,000 as the total interest paid for 2 years, and this pre-construction interest is allowed as deduction for succeeding 5 years. For succeeding 5 years, so first year is 15-16, second year is 16-17, 17-18, 18-19, and last year, the fifth year, is 19-20, which is the relevant year in this example. So pre-construction interest would be allowed to us, and it will be 3,60,000 divided by 5, which is 72,000. So 72,000 is the interest which is applicable, which is allowed to us. Fine. And apart from the pre-construction interest, even the interest paid during the year, in a way during the financial year 1920 in this example, this that will also be allowed, but that will be in under the overall limit of 2 lakhs for self-occupied property. So continuing with the example, in first para we have determined the rent amount, but for self-occupied property it is not relevant as GAV is 0, municipal taxes are 0. Only relevant factor in our case in self-occupied property is the interest paid. It could be either pre-construction interest or interest during the year. So pre-construction interest we have already derived, which is 72,000. Under the third para, on 31st of March 2020, Mr. X paid 2,40,000, which included 1,80,000 as interest. So 1,80,000 is the amount of interest during the year. There was no principal repayment prior to that date. Compute income from house property for assessment year 2021. Reconstruction interest we have already calculated. Now interest during the year is nothing but 1,80,000 which is paid. So total interest is 1,80,000 plus 72,000, which is exceeding 2 lakhs, and it will be restricted as per section sub 2 of section 23. It will be restricted to 2 lakhs. So income from, you can say, loss from house property, effectively loss from house property is nothing but it will be restricted to 2 lakh. Remaining amount can be carried forward to the next assessment year for the purpose of deduction, for the purpose of set off in the next financial year. However, in this year only 2 lakh amount will be allowed as deduction for set off against other income from other sources of income. So for this example, compute income from house property for assessment year 2021. The same answer is loss of house property, which is restricted to 2 lakhs. Next part, which is let out for part of the year and self occupied for part of the year. So we have studied section 1 of section 23, in which case if there is a let out property, if there is let out of the property, what is the gross annual value? Second part was in case there is a self occupied property, then what is the GAV and what is the interest amount which is allowed as deduction. And the fourth part, the third part that we can see, another part that we had discussed was in case of vacancy, what is the let out, what is the gross annual value of the house property. And the fourth part, we are seeing let out for part of the year and self occupied for the part of the year. So in these cases, if you know there is a of mixed bag, in which case it is the property is let out as well as there is a self occupied of the property, and in those cases one thing that you need to consider that section 23 says even if the property is let out for part of the year, even if the property is let out for the part of the year, then effectively it is being considered as let out for the entire year. So in our example, for example, if we take that the property was self occupied for 1 month and for the remaining part of the year the property was let out, so it will be termed as it will be deemed that the property has been let out for the entire year, vis-a-vis if the property is self-occupied for 11 months and it is let out only for 1 month, then also the property will be termed that it has been let out for the entire year. How it will be that the expected rent will be calculated for all the 12 months, and accordingly the let out income for the entire year will be calculated even if it has been rented out even for 1 month. So subsection 3 of section 23, expected rent for the whole year shall be taken into account for determining the GAV. So expected rent for the whole year will be taken into account for calculating GAV. Expected rent for the whole year shall be compared with the actual rent for the let out period. So in bold letters, the actual rent for the let out period. So since you can see there is a mismatch over here, the expected rent is considered for the whole year and the actual rent is considered only for the let out period, and whichever is higher is considered. So even if the property, in our example, even if the property is let out for 1 month, even if the property is let out for the 1 month, then also the property will be considered that it has been occupied, that it has been let out for the entire year, and accordingly gross annual value will be calculated. Municipal tax for the whole year is allowed as deduction provided it is paid. So if the municipal taxes has been paid on paid basis, it will be allowed for the whole year. What does the bare act says? Section 3 of section 23, provisions of subsection 2 shall not apply. The provisions of subsection 2, in a way we are trying to say subsection 2 is nothing but the self-occupied property subsection in which the gross annual value is nil. Clause A, the house or part of the house is actually let during the whole or any part of the previous year, or Any other benefit therefrom is derived by the owner. So the provisions of subsection 2 shall not apply. Subsection 3 of section 23 says subsection 2, which is self-occupied subsection, the gross annual value as nil will not be applicable where the property is let out for the part of the previous year. Even for the part of the previous year, if it has been let out, then the gross annual value won't be termed as nil, and the let out income, the actual rent, will be calculated, and it will be compared with the ER of the whole year, and whichever is higher will be GAV. Step 1, compute ER. Compute ER for the whole year. Higher of MV and FR but restricted to SR, it remains the same. Compute step 2. Step 2 is nothing but compute actual rent received or receivable actual rent received for the period let out less unrealized rent. Step 3 is nothing but compare ER for the whole year with the actual rent received for the let out period. Step 4, GAV is the higher of ER computed for the whole year and actual rent received receivable computed for the let out period. Gross annual value minus municipal taxes, which will be allowed on paid basis, and it's nothing but the net annual value. Deductions of 30% and interest remains the same. In the illustration, Mr. A owns a house property at Chennai. The municipal value of the property is 5 lakh. Fair rent is 4 lakh 20,000, whichever is higher. So 5 lakh will be the expected and it will be restricted to standard rent. So 4 lakh 80,000 is the expected rent. I will note it down. So expected rent is nothing but 4,80,000. Property was let out for 50,000 per month up to December 2019. So from April 19 to December 19, the property was let out, which is 9 months. Thereafter, the tenant vacated. Thereafter, the tenant vacated the property and Mr. A used the house for self-occupation. So it doesn't matter. As per subsection 3 is section 23, it will be considered that the property is let out for the entire year. So the actual rent over here is nothing but, obviously, it will be adjusted for unrealized rent. The actual rent for now is for 9 months, which is 50,000 into 9, which is 4,50,000. And rent for the months of November and December 2019. Rent for the month for November could not be realized in spite of the owner's efforts. All the conditions prescribed were satisfied. All the conditions prescribed under Rule 4 were satisfied. So November and December for 2 months it is not realized. So 2 months 50,000 into 2, 1 lakh, and actual rent now will have to be adjusted. Unrealized rent is 1 lakh. So actual rent is nothing but net amount is nothing but 3,50,000. And will have to compare expected rent and actual rent, whichever is higher. So in this case, GAV will be 4,80,000 being the expected rent. He paid municipal taxes at 12% during the year. That will compute. He will be eligible based on the amount paid. He paid interest of 25,000 during the year for amount borrowed for repairs for house property. So repairs amount 25,000. Anyways, it is less than 30,000, so entire amount will be allowed as deduction. Compute his income from house property for assessment year 2021. So 12%. Municipal taxes is nothing but 12% of 5 lakh into 12% is nothing but 60,000. Net annual value GAV was nothing but 4,80,000. So 4,20,000 is the amount of net annual value less 30% of NAV. There is nothing but 4,20,000 into 30%. Sorry, my mistake. It should be 4,20,000 into 30%. 1,26,000. 1,26,000 less interest, which is 25,000. So income from house property is nothing but 4,20,000 minus 1,26,000 minus 25,000. 2,69,000 is the amount which will be taxable as income from house property in this case. So in this case, the crux of the situation is, even if for the part of the year the house property is self-occupied, and even if the part of the year it has been let out, then the expected rent will be calculated for the whole year and it will be compared with the actual rent which has been paid, and the gross annual value will accordingly be calculated. Moving on to the next part, which is deemed to be let out property. So DLOP in short form. Deemed to be let out property is, for example, if the owner has five house property, if the owner has five house property and all of them are either self-occupied or unoccupied, none of them are let out. Okay, so two house property can either be self-occupied or unoccupied, but the remaining three properties will have to be deemed as let out property, and accordingly the gross annual value will be calculated as if the property has been let out. So in this case, for calculating the gross annual value, the expected rent will be for the whole year, and the actual rent will zero because it is deemed to be let out, it hasn't been actually let out. So expected rent will be the GAV, and the further process, that is the municipal tax deduction, the interest deduction, the 30% standard deduction, will be available to the SSC. On the screen, it's defined under section 23, subsection 4. The benefit of nil annual value is available only up to two self-occupied or unoccupied house properties. The other self-occupied, unoccupied property shall be treated as deemed to be let out properties. This option can be changed year after year in a manner beneficial to the SSC. So, for the five house properties, there would be certain permutation and combination on which, if considering one property is self-occupied and another property is deemed to be let out property, it will be at the option of the SSC to consider any of the property as self-occupied, and remaining properties can be considered as deemed to be self-occupied property. On this particular point, we will be taking an example to properly understand how it will be beneficial, I mean, through various permutation and combination, how one of the option will be beneficial to SSC and that can be applied by the SSC to save tax. So that is allowed as per law. In case of deemed to be let out property, last pointer, in case of deemed to be let out property, the ER shall be taken as the GAV because the actual rent would always be nil. There will be no actual rent in these cases because it is deemed to be let out property. Municipal taxes actually paid by the owner can be claimed as deduction, fine, but it should be paid. Now, what does the Bare Act says? 23 subsection 4, subsection 4, section 23, where the property referred to in subsection 2, which is self-occupied property, consists of more than two house. The provisions of that subsection, the provisions of subsection 2, meaning the provisions of subsection of that subsection shall apply only in respect of two of such houses, which the SSC may at his option specify in this behalf. Clause B, the annual value of the house or houses other than the two houses in respect of which the SSE has exercised an option under Clause A shall be determined under subsection 1. Subsection 1 is nothing but let out property, as if such houses has had been let out. So the deemed to be let out property are akin to let out house property are deemed to be LOP, and accordingly the provisions of LOP will apply to them. Even the interest calculation part, even the interest deduction part is also allowed. So which we will be covering in the next slides, in the subsequent slides. But however, just to give you example, for self-occupied property, there is a ceiling limit of 2 lakhs in case of interest deduction. However, for DLOP and LOP, there is no such limit, and the deduction can be freely allowed for more than 2 lakh as well. There is no ceiling limit for DLOP and LOP. There is only ceiling limit for SOP, self-occupied property. On your screen, particulars gross annual value ER is the GAV of the house property. ER is equal to higher of MV and fair rent but restricted to standard rent, which remains the same, less municipal taxes paid by the owner during the previous year. Net annual value and deduction remains the same. Deduction again start, and deduction under section 24 remains the same, 30% and interest on borrowed capital income from house property. In the illustration, Mr. X has 3 houses, both of which are self-occupied. 2 of them are self-occupied. The particulars of the houses for previous and 1920 are as under. So out of 3, 2 are self-occupied. They can be taken as, the gross annual value can be taken as nil, and the third property will have to be taken as DLOP. So house 1, house 2 and house 3, the municipal valuation, fair rent, standard rent has been mentioned. Date of completion, purchase has been mentioned. This is particularly for the interest deduction part. Anything, see, for this 31st March 1999, since it is before 1st of April 2019, since it is before 1st of April 1999, so there could be a limit on interest deduction, but there is no amount mentioned over here. And all the loan has been considered after 1999. Municipal taxes paid is as per percentage, 12, 8 and 6%. Interest on money borrowed for repair. So this is for repair of property, which is 55,000. So for self-occupied, this amount is restricted to 30,000. And for LOP, it is allowed freely. Interest for the current year on money borrowed in July 2019 for purchase of property. So it is for current year. So current year interest is 1,75,000 for house 3. Compute his income from house property for assessment year 2021 and suggest which house should be opted. This house should be opted by him to be assessed as self-occupied so that his tax liability is minimum. So there is always a scope, there is always a beneficial term for the SSC. So based on various permutation and combinations that we were discussing earlier, through this example we will know that which option is best suitable, which option is best suitable for SSC in minimizing the tax liability. Possibly we will have to consider various options, in which case house 1 and house 2, for example, are self-occupied, then the third property is deemed to be let out. So let's consider example by example. Let's take first property. Let's take first property as DLOP. So if it is DLOP, then we will have to compute its GAV. So let's mention this in the note section. Option 1 is house 1 is DLOP. So in that case, let's compute the GAV first. GAV would be nothing but GAV is equal to ER in such case, and it is nothing but 3 lakh and 375,000. So 3,75,000 fair rent is higher and it is restricted to standard rent. So ER is nothing but 3,50,000. Then municipal taxes we will have to consider. Actual rent in those cases is nil. Then municipal taxes is 12% of 3 lakhs. 12% of 3 lakhs is nothing but 3 lakh 60,000. Just to be sure, 12 lakh into 12%. Okay, no, that shouldn't be 12%. I feel this is 3 lakh. So 3 lakhs into 12% is nothing but 36,000. So less municipal taxes, which is nothing but 36,000. NAV should be 3,14,000. 3,14,000 is the NAV, and there is no interest amount over here. Fine. So this was house 1 and house 2. Obviously, we have to consider 30% standard deduction. So it will be into 30%, 94,200. And there is no interest amount. So 2,19,800 is the amount. We can say income from house property from house 1 is 2019. 2,119,800 is the amount. House 2. House 2 is nothing but we won't be calculating the GAV for it. Both are self-occupied properties. You will get the interest deduction only. So house 2, you can see 55,000 is the interest paid amount. It will be restricted to 30,000. Fine. Interest deduction, which will be 30,000. And house 3. House 3 is nothing but interest for current year on money borrowed in July 2019. Year July 2013 for purchase of properties 1,75,000 is 1,75,000. So house 1 we have income of 2,19,800. House 2 has negative amount 30,000 and house 3 negative amount of 1,75,000. House 1, 2 and 3 accordingly this loss 30,000 and 1,75,000 this will be restricted to 2 lakhs, and this will be adjusted against 2,19,800 which is the income of the property. Accordingly total income from house property under option 1 you can say is 19,800, which is 2,19,800 minus 2 lakhs. The interest amount is restricted because the interest is from the self-occupied property. So total income from house property under option 1 is 19,800. Now moving on, if at all, if the house property house 2 is considered as DLOP, I will delete this. And option 1 is this. Option 2. Option 2 is nothing but house 2 is the LOP, and accordingly remaining properties are SOP. So again, the GAV is equal to ER. GAV is equal to ER is equal to how much? 3,60,000 is the municipal value and 2,75,000 is the fair rent for house property 2. So whichever is higher, it is nothing but 3,60,000, and it will be restricted to standard rent, which is 3,70,000. Accordingly, 3,60,000 is the amount as GAV, which is municipal value. 3,60,000 plus municipal taxes, which is nothing but 8% of 3,60,000. 3,60,000 into 8%, 28800, 8800. NAV accordingly is nothing but 331,200. 331,200, and the interest amount which will be allowed for LOP property, we will have to consider 30% of NAV first. Also, less interest will be nothing but entire amount will be allowed because it is not DLOP, because it is not SOP. So it cannot be restricted to 30,000, and 30% of NAV into, you can say, 99,360. 99,360. So income from house property is nothing but 331,200 minus 99,360 minus 55,000, 176,840. 76,840 is the amount from, if we consider house property 2 as DLOP. Now moving on to the house property 1 and house property 3. So house 1 is obviously SOP, no gross annual value and no interest paid, so it will be nil. House property 3 SOP, interest amount will be entire 1,75,000, which will be negative. There will be no restriction on SOP because it is less than 2 lakhs. So 1,76,840, which is income from house property of house 2, is 1,76,840 minus 1,75,000. So 1,840. 1,840 total income from house property under option 2 is nothing but 1,840. I will delete this. So this is the first option. This is the second option. Option 2, house 2 is DLOP. Now moving on to the option 3. Option 3 will be house 3 is DLOP and remaining are SOP. So in this case, let's compute the GAV of the third property. 3,30,000 and 3,80,000 of house property 3, whichever is higher. So 3,80,000 is the fair rent and 3,75,000 is restricted. So 3,75,000 is the GAV. 3,75,000 is the GAV. Then less municipal taxes, which is 6%. 6% of 3,30,000. 3,30,000 into 6%, 19,800. So it should be 19,800. NAV will be 355 200. 355 200 is the amount. Then less 30% NAV and less interest. Interest amount will be applicable. Yes, it will be applicable. So it is negative 1,75,000 and no ceiling limit applied, and 3,55,000 into 30%, 106,560. 106,560. Okay. So income from house property from house 3 is nothing but 3,55,200 minus 106,560 minus 175, which is the interest amount, 1,75,000, 73,640. So moving on to the next house property, house first, SOP. SOP is nothing but it will be nil. House 2, SOP. It will be restricted to 30,000 because it is a self-occupied property. So effectively 73,640, 70 again, start. 73,640, which is income from house property from house 3, it will be set off from 30,000, which is SOP interest amount. So it should be 43,640, the amount 43,640. So I can say over here option 3, total income from house property is nothing but 43,640, and this rest all can be deleted. So if we evaluate the options over here, option 1 is house 1. If house 1 is DLOP and other house property, house 2 and house 3 are SOP, then total income is 19,800. If house 2 is DLOP and other house are SOP, then income is 1,840. And the option third, the income is 43,640, in which house 3 is DLOP and other house property are SOP. So the beneficial option for SSC is to go as house property 2 as DLOP, and the other option, the other houses should be termed as SOP. In that scenario, the total tax liability of the SSC will only, the total taxable income will only be 1,840. Moving on to the next part. So in this section, just to sum it up, we have studied which is the beneficial option for the SSC, where there are more than one self-occupied property in case of deemed to be let out property, how the options which are more beneficial, which are highlighted over here, which are more beneficial for the SSC should be considered. So we have considered an exhaustive illustration also, in which case there were three house property, and which out of various permutation and combination, which house property was more beneficial for the SSC has been considered over here. Now moving on to the next part, which is subsection 5 of section 23, which is house property held as stock in trade. So previously also we gave an example of a builder in which case he has the society, he has the units as ready to be sold, however he is unable to sell it. So the law provides him an exemption. The builder is provided an exemption for 2 years from the receipt of the completion of certificate. So if the completion of certificate, the CC certificate, the completion certificate, if it is received on April 2019, for example, so from the end of that financial year, that is from March 20, we will have to count 2 years, up to 2 years from March 20 in an example, the builder won't be charged any amount. I mean, none of the properties will be considered as DLOP. Also, one more condition is the property during this period shouldn't be let out by the builder. If it is let out, then this benefit, this exemption of 2 years won't be available to the builder. On the screen, section 5 of section 23. Pointer 1, held as stock in trade and the whole or any part of the property is not let out. So even part of the property shouldn't be let out during the whole or any part of the previous year. Again, pointer 1, held as stock in trade, the property is held as stock in trade and the whole or any part of the property is not let out during the whole or any part of the previous year. In such cases, the annual value of such property or part of the property shall be nil. The property value shall be nil. This is the benefit available to the builder, to the SSC. Annual value will be nil for 2 years. Will be nil for 2 years from the end of the financial year in which certificate of completion is received. So from the end of the financial year in which the certificate of completion is received, the SSC is eligible for such benefit. And the example of a builder is just an example to clarify the things of this subsection. So the barrack, where the property consisting of any building or land appertaining thereto is held as stock in trade and the property or any part of the property is not let out during the whole or any part of the year of the previous year, the annual value of such property or part of the property for the period of up to 2 years from the end of the financial year in which the certificate of completion of construction of the property is obtained from the competent authority shall be taken to be as nil. So the sixth portion was related to the stock in trade, in which case a benefit is provided to SSC in the form of gross annual value being considered as nil for 2 years from the certificate of completion, from the end of the financial year in which certificate of completion is received. Now moving on to the next part, which is a portion let out and a portion self-occupied. Meaning you may have a part of the property which is separable. In a way, consider a property, a building with 3 floors, and in which case the property on each and every floor is separable, and accordingly the ground floor may be self-occupied. However, the upper floor or any of the upper floors may be let out. So in those cases, both the units, each and every floor will be a separate unit for the purpose of taxability under the head income from house property. So the 3 floor building, ground floor, first floor, second floor, third floor, any of the there are 4 different units in those cases, and any of the units can be considered as SOP, LOP, DLOP based on the portion which can be occupied, which can be let out. So on your screen, income from any portion or part of a property which is let out shall be computed separately. It should be computed it separately, because there could be a thing in which, if for example first floor of the property is let out, then the entire property should not be deemed to be let out. So the intention of this provision is, if a property can be separated, is a divisible product, is a divisible unit, then that property will be let out, and other property, the benefit continues to remain as self-occupied property. Income from a portion or any part of the property which is let out shall be computed separately under the let out property category, and the other portion or part which is self-occupied shall be computed under the self-occupied property category. But having said that, in our example, it should be like that, there is a separate provision for each and every floor. For example, there should be a separate door for each and every floor through which an independent entity or independent person can go can go to and fro. So the properties, the characteristics which are part of a property, part of a self-occupied property or lettered property should be retained, and then only we can consider them a separate unit, and accordingly the benefit of self-occupied property being considered as let out property will be mentioned over here. So pointer one says that if the units are divisible, then the property can be separated. Second pointer, there is no need to treat the whole property as a single unit for computation of income from house property. And municipal valuation, fair rent, standard rent, and property tax shall be apportioned between the property. This we will be considering through an example. Now, property taxes, municipal taxes, we have already considered it, that if the owner is if the owner is paying the property taxes, then the amount will be eligible as a deduction from the gross annual value. So the property taxes are allowable as deduction from the gross annual value subject to following two conditions. First, it should be borne by the SSC owner, fine, and it should be actually paid during the previous year. It should be actually paid during the previous year, and it should be paid by the owner. Continuing, for the municipal taxes, in case of properties situated outside India, taxes levied by local authority of the country in which the property is situated is deductible. So for property outside India also, the municipal taxes paid outside India is allowed as deduction. For self-occupied property, unoccupied house property, deduction of municipal taxes paid is not allowable. In the illustration, Mr. A, a foreign national, is ROR in India during the previous year. He owns a house outside India which he has let out at 10,000 per month. The municipal taxes paid to the municipal corporation is 8,000. So it will be allowed, as we have seen in earlier example, during the previous year 1920, the value of £1 is 92.50. Fine. Compute A's net annual value of the property for assessment year 2021. So it's that the let out property it's for 12 months. So 10,000 into 12 is 1,20,000, and 8,000 deduction will be allowed. So I will have to note it down. So the gross annual value in this case is, first we will mention everything in pound sign, then less municipal taxes which will be allowed as deduction. And is there any interest amount? There is no interest amount. So income from house property will be nothing but 1,22,000, like 12,000 into 30%, 33600. This will be 33600, and this will be 78,400 is the amount. These are the pounds amount, and it should be converted into INR, which will be into 92.50 is the INR amount, and accordingly, here they had asked only the net annual value actually. So the net annual value in our case was 1,12,000. So in our example, 1,12,000 pounds is the answer for computing the property where you have paid municipal taxes outside India. So this example is just to mention that municipal taxes paid outside India is allowed as deduction. Illustration 2. Mr. C owns a house in Madras. In the previous year 1920, two-third portion of the house was self-occupied and one-third portion was let out for residential purposes at a rent. So one-third portion was rented out. Municipal value of the property is 3 lakhs. Their rent is 2 lakh 70. Whichever is higher between these two is the expected, and it would be 3 lakh will be restricted to standard rent. So municipal value is the expected rent value. We paid municipal taxes at 10% of municipal value. Okay, we have to calculate income from house property. So we need a working note. So GAV in our case is 3 lakhs, which is municipal value as 3 lakhs higher between the fair rent and municipal value, which is 3 lakhs, and standard rent is 3 lakh 30,000. Accordingly, GAV is 3 lakhs. Municipal taxes is nothing but 10%. So it is 30,000. NAV is 2 lakh 70,000. 30% NAV less interest. A loan of 25 lakh was taken by him during the year 2015 for acquiring the property. Interest on loan paid during the previous year was 1 lakh 20,000. So as such, there is no mention over here of pre-construction interest as such. Okay, 1 lakh 20,000 will be available, but somehow we are mentioning where we need to mention the apportionment amount. So for self-occupied property, two-third self-occupied property, two-third of the value will be available as interest, and the gross annual value will have to be apportioned over here as per the rented amount. So let's first consider the LOP property. For LOP property, the net annual value needs to be apportioned over here, and the interest amount will also be apportioned. Apportioned amount to be mentioned over here is before mentioning the apportioned amount, I feel we should be comparing the expected rent with the actual rent as well. So the expected rent was 3 lakh, and the one-third portion of it is nothing but 1 lakh, and actual rent is nothing but 8,000 per month. So 8 into 12, which is nothing but 96,000. Whichever is higher, we'll have to take it. The gross annual value is 1 lakh. So the apportionment amount, this should also be one third. So the amount which is taxable, it should be 90,000. This is again divided by 3. So this is from the let out property N. The NAV of 30% is nothing but 27,000. Yes, 27,000. And interest amount should be, again it should be apportioned and it should be divided by 3. So 40,000 is the amount available. This should be 27,000. So income from house property is nothing but what is the amount over here? 90,000. 23,000 is the income taxable, and the income from self-occupied property, you will get a deduction of two-third amount of the interest. In a way, interest from SOP property is two-third of 1,20,000 is nothing but 40 into 2 is 80,000. So loss from house property ultimately it will be 57,000 negative amount. So the loss from house property for assessment year 2021 is nothing but 57,000. So this comes to an end. We are at the end of the section 23, in which case we have studied how to determine the annual value as per section 23. In first part we have studied how to determine the gross annual value when the property is let out. Second part, how to determine, again start. Second part, how to determine the LOP, the let out property where the property is vacant. Third part was what is the gross annual value and what is the interest amount deduction where the property is self-occupied. Then what is the gross annual value in cases of when the property is let out for part of the year and let out for and self-occupied for the part of the year. And then we have studied when the property is let out for the portion of the period and self-occupied for the portion of the period where the units of the property are divisible, where the units of the property are separable. So in those cases, the section 23 determination of annual value we have determined, and there are various subcategories 1 to 7 in which how to determine the gross annual value, how to determine the expected rent, actual rent, unrealized rent, what is the actual rent in case of vacancy. This all we have determined. This section is the crux of this chapter of the income from house property. Hope you have understood it, and you can go through the illustrations again, which will clarify your concepts related to the subsections of the section 23. Thank you.